I'm here to talk about whether or not fund structures offer higher returns than investing directly into peer-to-peer assets. And in case anyone has any doubts about the journalistic integrity of AltFi, and indeed of Ryan Weeks specifically, I'd just like to go on record and say that I didn't choose this topic. And in fact, when Ryan told me I'd be talking about it for 30 minutes, I pointed out to him that there are only a handful of funds, and most of them have been around for less than a year. But he told me, AltFi Data's got the data, tell the story. So I guess here we go. So before we go too far into the facts and figures, I wanted to borrow from the great Lloyd Blankfein. There's so much wrong with these series of comments. But I think, as well as recognizing that, I guess, to some extent, we're all here exploring the extent to which banks have got terrible customer service, terrible net promoter scores, legacy branch networks they don't need, even more legacy IT, which makes it hard for them to analyze new sources of data. In some cases, a reluctance to even acknowledge there is more data out there. But aside from all of that, this industry, this alternative finance industry, was also given the opportunity to spawn against the backdrop of widespread skepticism relating to banks. And I think, to some extent, we have to thank comments like this from Mr. Blankfein. But it's interesting when you reflect on this, because actually, all he really did was defend the multiplier effect. And actually, that's all alternative finance is doing too. It's just the multiplier effect. It's just getting credit to companies and consumers. But I think what's most interesting about this comment and what's wrong with it is that what he explained, the multiplier effect, is all that credit's been doing for thousands of years. When Jesus Christ expelled the moneylenders from outside the temple in New Testament times, that's what they were doing. And so it's interesting to reflect, because what's really wrong with this statement is that he's really claiming a bit too much credit for doing something in the same way as it had always been done. And the point I want to make is that alternative finance is doing it genuinely differently. And that's because alternative finance is doing it in public. Alternative finance is doing all this transparently. And we've labored, that's putting it a bit far, but we've talked a lot about transparency today. But I think it's important to recognize exactly what the difference is here. And ultimately, a large part of the difference comes from what we're comparing it to, which is banks. And banks are amazingly opaque. Now, part of that is that they're quoted companies, and therefore, justifiably, they have quarterly reporting, which builds in a big lag, and so it takes a while to figure out what's going on in their loan books. But there's much more to it than that. They all use provisioning, because provisioning smooths profits, and it's become conventional wisdom. But the problem is, provisioning really is just an enormous excuse for opacity. Okay? Provisioning allows them to say, well, I provided for it, so I don't need to show you exactly how bad it's got yet. Okay? Now, that is what is totally changing. And we'll talk about the benefits that brings to the platforms and the industry, but I think just to for a moment, be also reasonably opinionated about another recent set of quotes. One thing I find staggering about, or perhaps the thing I found most staggering about Lord Adair Turner's recent comments, is that as an ex-regulator, and indeed a regulator in a time where the opacity of banks caused a horrendous problem, one of the things he didn't talk about in his Radio 4 interview was the benefits this could bring to the system. So just imagine a world where, rather than having to wait for months and months and months to find out what a representative sample of credit risk is doing, we're now entering a world where we can track what a representative sample of credit risk is doing in real time. This is truly a revolutionary benefit. Now, these levels of disclosure that we enjoy in alternative finance are because platforms have subscribed to that disclosure. And it was very interesting, the debate between RateSetter and OnDeck earlier today. And clearly, this is quite a nuanced point. And I suppose the context I would like to put behind this is, clearly there is a logic to capital as the skin in the game for a balance sheet lender. In fact, it's its modus operandi. And so the debate of which one's better, like many debates, is kind of Depends on which model you're using. But we believe very strongly that in the context of pure marketplace lending, disclosure is much better skin in the game than capital. Okay? And we believe that most marketplace lending platforms recognize that. And the reason that's the case is because loan disclosure is effectively saying, I'm going to fix the agent-principal conflict. I'm going to prove an alignment of interests by disclosing my loan performance. So sure, I'm not risking capital alongside you, but I'm going to show in real time what my lending decisions are doing. And if they look poor, you're free to vote with your feet. Okay? So accepting that there is a logic to balance sheet lending, skin in the game, and kind of peer-to-peer lending where there is no capital skin in the game, in that pure peer-to-peer online lending context, we think disclosure is absolutely central. And I want to come on to show you that within that online lending market, we think you can very clearly see already that investors, effectively the marketplace, favors disclosure over capital as its preferred form of skin in the game. The UK is blessed with an incredibly transparent online lending marketplace. And the P2P FA have to be acknowledged in terms of their role in this. Standard definitions for defaults, arrears, etc. were introduced in June 2014, I think. We made disclosure of a platform's loan book a requirement for joining our Liberum AltFi Returns Index, which we'll come on to look at, this time last year. And at that point, Zopa and RateSetter joined Funding Circle in terms of disclosing their loan books. And it's important to note, I think, that in October last year, that also became a P2PFA requirement. So now all P2PFA member platforms, and indeed some others, are disclosing their loan books and recognizing the logic of being totally upfront and transparent about lending performance because it creates an alignment and it encourages investment. Clearly, I run a business which has an enormous vested interest in transparency. And so we want to kind of guide people to what we're looking for here. And so we've created a spectrum. And we also recognize that it takes time to get up the spectrum. And it's often not a function of an unwillingness to get there. It takes time. To the left, we see the very basic, which is volume origination. Clearly, nobody can get a sense of risk, what's been lost, if nobody knows how many loans were originated in the first place. So that is a basic prerequisite. We take volume data from 56 platforms around Europe now, and we think that's a great starting point. You then graduate towards loan performance statistics, which a platform itself discloses. That is obviously a big step forward, albeit it's the platform telling the world what their loan performance is. It's not in any way independently verified or in a comparable format. You then get onto disclosure of fees, and then you get onto publication of loan books to a standardized methodology. And then you get towards what we really think the aim is, which is industry standard loan performance statistics. And beyond that even, loan performance statistics which can genuinely be compared like for like. So the way we try and solve that is we take loan by loan cash flow data. So we then take a standardized input and we get to decide what the output is. So we get to dictate how things can be compared apples for apples rather than having to marry up a whole different range of outputs. Now I want to try and illustrate the benefit that we think transparency can bring to a platform. And I'm going to show you this subset of platforms circled, and I'm going to show you how they've benefited in terms of attracting investors and growing extremely quickly. Now, on the very far right of this spectrum, you'll see the four constituents of our returns index. Zopa, Market Invoice, Funding Circle, RateSetter, joined basically by the other members of the P2PFA. Now, broadly, the benefit of transparency has been attracting investment funds, attracting on-platform investment. And arguably, I could have shown you here just the growth rates of all these platforms. But that actually oversimplifies it, because it needs to be acknowledged that many of these most transparent platforms are also the biggest platforms. So if we just look at percentage growth rate, clearly there are some smaller platforms earlier in their evolution growing incredibly quickly. And what's actually impressive about what these transparent platforms have done is that they are often very large and yet still growing very quickly. What this chart's seeking to illustrate is market share of those transparent platforms. And we have to acknowledge the context here, which is that this has become a very competitive marketplace quite quickly, as it would do. There are no barriers to entry fundamentally. And what you need to think about here is that since 2013, there has been a welter of new entrants. And yet, in 2014, that weight of new entrants stopped eroding these transparent platforms, which also generally were the more established, more mature ones. And even against the backdrop of a weight of new entrants, the big guys started growing at the expense of the rest. Okay, so the number of other people in the marketplace was growing and growing and growing, but the big guys were getting bigger. And I think you can quite clearly see that transparency has brought a benefit to these very transparent and open platforms. This is the same chart, slightly different scale. Trust me, it is the same. And I just wanted to go through a little bit of a timeline of kind of some significant events in terms of transparency. So if you imagine that the chart actually goes way back to 2005 when Zopa launched, and then the first point we actually mark on the chart is Funding Circle launching in 2010, which was a big step forward in that Funding Circle at the outset launched with a transparently disclosed loan book. We then wind forward through a whole load of new platform launches until we get to May 2014. Is this related or not? Up to you to decide. When the first big institutional specialist investor IPO'd. We then got the P2PFA standard definitions I mentioned. And then in February 2015, Zopa and RateSetter joined Funding Circle in terms of publicly disclosing their full loan book. That was a eligibility requirement for our index, as I mentioned, and that then allowed us to launch our index pretty much this time last year. Market Invoice then followed suit, and we were able to add them to our index in the summer of last year. And subsequent to that, the P2PFA have made loan book disclosure a requirement. And we very much hope that we're about to be able to deliver some more transparency with the launch of our analytics product. Sam would kill me if I didn't do a shameless plug. Our analytics product is in beta test at the moment. It's not perfect. We're adding significantly to the functionality. We're also trying to iron out some wrinkles. But we would love any feedback. It's being demoed at the back of the room. I'll come on to say a bit more about what it does. But there's the plug out of the way. So what we can conclude is that disclosure seems to have fueled growth. And I think it's fairly simple to understand why. And that's that disclosure allows due diligence, and it mitigates this agent principal conflict. It solves this problem of, hey, platform, where's your skin in the game? Why am I going to risk investing in the loans you post on your platform when you're not taking any risk yourself? The platform is saying, I'm prepared to be held to account. Okay, I'm going to demonstrate what I'm doing in real time, and if my lending's rubbish, you can go somewhere else. So accountability has been demonstrated, but more importantly for the benefit of the asset class that's emerging, is that because of disclosure, we're able to now calculate the real returns of this industry. So as I say, I'm going to dash through this because I fear many of you have heard it before. Last year, we launched the Liberum AltFi Returns Index. This takes every cash flow from every loan originated from those big four platforms. The output is a 12-month return. So 6.41% is what you would have accrued from owning these assets over the last 12 months. But it's important to understand the portfolio is a lot older than that. Okay? It's every loan originated by those platforms on a time-weighted basis. Okay? So you hear people talking about seasonality. Not seasonality. Speedboating is the only term for it I can think of at the moment, but there's another one. Effectively, what it mitigates is the youngness of this industry, whereby if you don't time-weight a series like this, you've got way too many young loans, not enough old loans, and therefore your returns are overstated because your defaults are underrepresented. So the output is a 12-month return, but the portfolio that drives it is much, much older than that. Effectively, the same amount of capital is allocated to the far quarter as the near quarter. And we can see that this industry is demonstrating impressive returns against comparable asset classes. We have now taken the cash flow data that drives that index, and we've put it into a market data product. And I'm going to now walk you through some of the aggregated outputs. Okay, so we can show platform by platform data, but we're going to look at aggregated data for now. So we can see gross lending rates in the industry are around 8%. We can also look at bad debt. Now, this is unseasoned. Okay, so this is effectively being generous, okay, and understating bad debt because there are way more young loans in here than old loans. We can obviously give you a seasoned version, but we also like to look at bad debt on a cohort basis, and the tool can also do that for you. So effectively, if we're now showing you the data we've got, what we can do is we can confidently assert what quoted structures, what fund structures should be expected to achieve. Okay, we've got gross lending rate, we know defaults, we can add back recoveries, we know fees. Okay, we can therefore create a benchmark return, a return that an asset manager who's purporting to deploy into the space should be expected to keep pace with. So, having looked at that return versus other asset classes, let's now get to the punchline. Let's talk about our benchmark return versus what these fund structures have actually delivered. Now, it's important to emphasize we're looking at NAV here, okay? So benchmarking is a game of identifying asset manager skill, okay? So for now, we're just going to look at NAV. And what you can see is the blue line is our index, and the colored lines are the various funds. And broadly, I think the funds have done a pretty damn good job of keeping up with the benchmark. Particularly because they've been scaling up and deploying, and we'll come on to explore that. Each of the individual fund lines has a bit of a story. So Victory Park are able to deploy extremely quickly because they extend funding lines to people who do lending, so they get to take down a significant chunk of the capital they've raised very quickly. Ranger, interestingly, don't hedge their returns. So that's their unhedged line. If I showed you the sterling return, it's much, much better than that. But clearly, that's not manager skill. That's just a currency effect. So that's the dollar Ranger line. And it's struggling to keep up. But actually, on a sterling basis, it's much, much better than that. P2P-GI has definitely had the biggest challenge in terms of deploying the most amount of money and therefore having cash sitting on its balance sheet. And you can see that it's suffered with that, but it's now beginning to get into its stride and beginning to deliver returns comparable with the benchmark. So let's just explore this idea of leverage, because aside from the fact it's a massive factor in why I think fund performance is about to accelerate, it also slightly touches on one of the previous panel discussions which talked about alpha. And Simon Champ referred to alpha generated using leverage. This is a slide which P2P-GI disclosed a week ago or so. And I want to point to two numbers on there, really. The first number I want to point to is the weighted average coupon in the ordinary shares versus the C shares. And what you can see is that the ordinary shares seem to be investing in lower risk loans because they're getting a lower weighted average coupon. And the reason for that is explained by the number in bold below, which is the leverage number. So as Simon alluded, by using leverage, they can achieve a higher return to meet a return target using a lower risk loan. So if there's a mispricing there to exploit, they can use leverage to exploit that. So that demonstrates how these funds can generate alpha. But the other thing that this slide demonstrates is the extent to which leverage has been a problem for funds like this and is about to potentially become an advantage. And that is basically because leverage costs money, and the facility costs money whether you're using it or not. And interestingly, the C shares and ordinary shares, P2P-GI, or the Cs have just converted into ordinaries, and so there's now just one line, and the one combined line has leverage of around 50% versus a target of, I think, 100%. The point being there is a cost associated with that leverage that is not yet being used, but there is clearly a motivation to use it. So you would expect, as that leverage is deployed, you would hope that they would be able to outperform the index further. So let's just try and summarize that, because I think there's a really important message here, which is that NAV performance I would expect to begin to increasingly outperform our index. A big negative has been deployment. And I suppose it could be these funds keep issuing follow-ons and they keep having deployment issues, but proportionately that's going to fall at the very least. So the negative drag of deployment is going to reduce, that's for sure. Cash drag is not something my index suffers from. Okay, you could academically say that's a problem, but there's not really much you can do about it. So the simple reality is my index doesn't suffer from cash drag. Funds will always suffer from a little bit of cash drag because clearly they've got to have a small amount of cash waiting for deployment opportunities, etc. Fees is also something that the funds have to overcome. So our index is net of platform fees, but the fund performance is obviously reported net of the fund manager fees. So there's a much bigger fee to overcome there to keep pace. Next we come to effective leverage, and this is one where I think a negative is about to swing to a positive, as explained. And the other thing to be considered is equity stakes. Now, clearly the asset class has delivered a positive return. Equity stakes at best are still in there at cost, so they've delivered nothing. You may not think they're going to get marked up at some point, but certainly, they can't do any worse. Well, they could do worse than be marked at cost, but I think given how early those investments were made, that would seem unlikely. So I think there's a decent case to be made to say that performance could accelerate. And that's really important because I've talked about NAV returns so far. And actually, if we think back to the question, you would have done much better investing directly in peer-to-peer platforms in the last 12 months than investing in these structures, because these structures are accessed through their share price, and the share price performance has been poor. Now, it's worth contextualizing this and to say that 12 months ago, P2PGI was at a significant premium. So they were the only ones or Victory Park only just arrived, Ranger arrived a couple of months later. P2PGI was at a chunky premium, and so its share price performance looks much worse, partly because that premium was just being eroded. Actually, all those funds are trading at a very similar discount to NAV of around 10%. So because the market has chosen to price these funds at a discount, investing through these funds has delivered much worse returns than investing directly on platforms in the last 12 months. Now, I think there's a very strong case that benchmarking forms part of the answer as to why that might have happened. So let's first think about, was I right to look at the NAVs of these funds versus Liberum AltFi Returns Index, which is made of peer-to-peer lending assets that actually represent 70% of the UK market? And the reality is those funds actually overlap to a greater or lesser extent with our index. Okay, some of them have a very, very significant overlap, some less so. So you could say, oh, well, it's not a perfect match, so it's not the right benchmark. That's not actually what a benchmark is seeking to do. What a benchmark is seeking to do is contextualize performance. And effectively, it's trying to compare what this question is doing, which is to say, would you be better off investing in the fund, or would you be better off investing in the alternative? And the alternative clearly is investing on the platform directly. These are all UK-listed funds. So if you didn't invest in these funds, you would have thought the most likely thing you would have done is invest in UK, maybe European domicile platforms. So we think that the return our index represents is absolutely the right benchmark for these products. We also think that these products would gain a significant benefit by benchmarking themselves against that index. So let's just reflect on the benefits that benchmarking can bring. Well, actually, I think I'm going to start on the bottom of this slide, because the first point to make is that all established asset classes use benchmarking. Benchmarking contextualizes the return and is almost a symbol of maturity. And it's a symbol of people understanding what an asset class can deliver. But as well as delivering a benefit to the entire asset class, benchmarking, I believe, would deliver a significant benefit to the asset manager. And that is because not only does it contextualize performance, not only does it allow the asset manager to demonstrate the skill that in fact they are delivering. They are delivering a good performance in NAV terms against that benchmark. But not only does it illustrate performance, it also illustrates accountability. And this brings us right back to what the platforms have done. Platforms have mitigated the agent-principal conflict by demonstrating accountability, by demonstrating alignment. And that is exactly what an index does, exactly what a benchmark does to an asset manager. So we believe that an asset manager, as well as gaining a marketing benefit from illustrating his performance, gains a further marketing benefit from adopting best practice and proving his accountability. So, to conclude, from an NAV perspective, funds have delivered an excellent performance versus what they could reasonably have been expected to deliver, versus an index of online lending assets. However, accessing online lending assets has been much, much better done on a 12-month historic basis directly through platforms where you should now have 6% versus through these funds where, let's say you invested at the float or even after the float at a premium, you could be nursing quite significant losses. We believe that benchmarking would bring a benefit to the entire industry in terms of communicating the returns that are available here, but we also think it brings a very clear benefit to the asset managers. It demonstrates the returns, it illustrates the skill they're delivering in terms of delivering returns, and it also demonstrates their accountability. And in demonstrating that accountability, they would in fact just be extending the principle that this industry is all about and that so differentiates this industry from what's come before it.